Most people think the Iran war is the biggest threat to our economy right now. They're not wrong, but it's actually the combination of 6 major pressure points happening simultaneously that make the war so dangerous for our economy. I'm going to break down all 6 as simply as possible and what it means for your investments. Stay with me because the one that ties them all together is the one that's often least talked about. With the war raging in Iran, the waterway moving 20% of the world's energy and critical materials is blocked off, causing hundreds of billions of dollars in economic losses and pushing the prices up of everything across the board. This price shock is landing in a fragile US economy. Consumer and government debt are at all-time highs, and the job market is weak. America can run on debt because they can make monthly payments. But this inflationary shock combined with a weak job market puts those payments and ultimately our economy in danger. And it's not just everyday Americans anymore. Private credit, where the smart money invests, is showing signs of cracking. Rising defaults, funds gating investor withdrawals. Because these are private loans, nobody knows how bad the damage really is. Jamie Dimon said it best. When you see one cockroach, there's probably more. This credit risk is exacerbated by the yen carry trade. Institutions for 2 decades have been borrowing Japanese yen and plowing it into US assets. With Japan shifting economic policy, this trade has become much riskier and has been putting pressure on US asset valuations. The war is also compounding against this issue. Iran is challenging the status of the US petrodollar. In the 70s, the US made an agreement with the OPEC nations to sell oil in USD. The proceeds from those sales were recycled back into US treasuries, which kept borrowing costs artificially low. Due to the war, Iran has now taken control of Middle Eastern exports and has begun selling oil in the yuan instead of the dollar. All of these issues tie back to monetary policy. We've gotten used to the Fed bailing out the economy by lowering rates and printing money. But now we're at an unsustainable level of debt, increased inflation risk, and weakening liquidity, which is driving the bond markets to demand higher yields. These higher yields destroy stock market valuations and drive up the cost of US debt, which further worsens our economic position. This is all hitting when US stock valuations are near their highest valuations in over a decade, with history showing below average returns when valuations are this high. But this doesn't mean you panic sell everything. Data and history show that no one can predict when or where the markets are heading, but it does show that if you miss the best days in the markets, your investment returns significantly get hurt. Follow along and I'll share investments I'm considering, why holding assets are still so important, and why buying during this time period will likely be the right decision. See you in the next one.